Cathie Wood's ARK Invest fund just dropped $27 million to buy Tesla stock, which is about 10 times more compared to the normal amount that this fund buys each time they decide to purchase more Tesla stock. That was yesterday, and 2 days ago, you can see right here that usually each time you can see 1 million, 4.6 million, 4 million, 3 million, 1.4 million, 2.8, 2.7, 2, 2.7. There was one purchase of 12 million, but usually it's about $2.5-ish million, but there is room for $270 million more. However, this is quite bullish to drop $27 million all at once. So why is Cathie Wood doing this? Well, ARK Invest's base case is $4,600. This was before the stock split, so a little bit over $1,500 as a base case for 2026. That's more than a 10x in just a few years. But it gets even crazier here. You can see 2030 here, and after the split, when we adjust for the split, you would have over $7,000 per share. That's a lot more than a 50x from where we are right now. This is a good time to revisit what Cathie Wood has said before, back in 2020 on February 5th. Cathie said before that Tesla stock would be at $7,000. This is before the two splits, which after these two splits, it would be $466-ish, which already sort of happened almost. Notice that she said over the next 5 years. And this is from 2020, so we still have a few years to go. Let's dive in.
All right, we talked about Tesla bulls, and we're going to meet one in just a moment. In fact, one of the biggest ones on the street. But to preface that, Tesla's wild ride has left many of the analyst community in the dust. Check out where analysts stood just a year ago on this stock. Average price target was roughly $300 a share, just above where shares were trading at the time. Today, the average price target is closer to $500 a share.
That's about $33 per share. Split adjusted. Can you imagine Tesla stock at $33? That would make the trailing PE of, it would put it at less than 10, about 9.5. And the forward PE would be at about 6, which is where GM is right now. And remember, back then, analysts were saying that Tesla would go down from where it was at that moment. Currently, even analysts are saying Tesla is supposed to go up 12 months from now.
Next guest thinks Tesla has room to run. In fact, she thinks Tesla could hit $15,000 a share within the next 4 years. Let's bring in ARK Invest CEO and founder Cathie Wood. Cathie, welcome. I know $15,000 a share is not your base case.
No.
It's your reach case. What is your base case of where this $700 stock is in 4 years?
Yes, the base case, it's a 5-year target, so the end of 24, it's $7,000. And we've arrived at that price by weighting the probabilities of 10 different scenarios, including bankruptcy, to be honest. So we've tried to be as fair and balanced as we possibly could be, but our confidence level that this stock is heading for $7,000 over the next 5 years is very high.
So you take out your lowest probability scenarios, you take out the ones that you think just aren't going to work, or the highly outlandish ones where everything has to click exactly right. On what bricks is this $7,000 foundation founded? Is it improving margins? Is it lowering the cost of production of the vehicles as they get up to scale, or what?
Yes, there are 3 sources for the increase in our estimated price target. One is, as Tesla killers entered the market last year, we expected Tesla's market share to go down from 17% globally, that includes China, to something lower. Instead, it went up to 18%.
And here are all the numbers that came the next quarter after that interview, you can see Tesla went as high as 30%. And you can really only go down when you reach market share penetration that high. So naturally, it went down to more a natural number of about 18%. And it's a little bit lower right now. And the reason for that is Tesla was planning to release the compact, but it didn't. Tesla was able to increase the prices of already super expensive cars even further. The Model 3s, Model Ys had so many price increases, so of course you would focus on selling more of these cars instead of making a compact, which would make less per car. So it's only natural to do that. So the competition needs to watch out for when Tesla releases that compact.
So what we're learning is Tesla is just so far ahead of the pack. And I'm talking about the BMWs, the Mercedes, as far as range and other important metrics when it comes to electric vehicles. Their battery cost is 3 years ahead, 3 to 4 years ahead of any other auto manufacturer in terms of the cost declines. And so every other auto manufacturer will, if they want to be competitive with Tesla, and I'm including BMW and Daimler and all, if they want to be competitive, like for like, they will have to sell their cars at a loss at the same time they're losing their internal combustion engine business.
Last year, Tesla delivered about 10 times more EVs than Mercedes, all while these legacy automakers were losing money selling battery electric vehicles.
So they have a big problem. So
are you confident enough in their ability to overcome what I would call sort of manufacturing hairballs that have struck them in the past and caused them to miss or delay production targets?
So nothing is in a straight line, you can't promise, but what they did in Shanghai was unbelievable. Breaking ground and producing within a year. And I think they're taking those learnings elsewhere. In Germany, outside of Berlin, we've been thinking, okay, that's a setup for bureaucracy. They have been welcomed with open arms because Germany doesn't want to lose the auto industry, right? And they don't want to lose the jobs. So, and now we're hearing potentially about Texas. So we think they're going to surprise on the production side now. It took a lot of trial and error, just like with their Falcon rockets. When they were trying to land them, it was failure, 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 then success. And now they've been successful pretty much every time since.
Yeah, so kudos to you. I mean, you had what I thought was an outlandish target 2 years ago or 1.5 years ago, and here we are. And so you have another one, maybe outlandish, maybe spot on.
And here we are again. Tesla has reached, well, at one point almost, that $7,000 price target, which is $466 split adjusted. And I, of course, believe Tesla will not only go back to all-time highs, but will surpass these all-time highs. Then, exactly what happens, we will find out.
But let me ask you, when you get to this 7,000, to pick your more moderate case, what's it trading at? As a multiple of earnings, or as a what will that valuation then be?
So in 5 years, again, we don't really operate like that. We're just trying to figure out the cash flows and then discount them. But one of the things that I'd like to focus on is the reason this is going to be such a big upside surprise is because Tesla is riding the convergence of 3 major innovation platforms. Convergence. It's very hard to analyze this in the traditional world, right? Auto analysts are not robotics experts. They are not artificial intelligence experts or battery experts. We have 3 analysts working on this model together. All of them are characterized by exponential growth during the next. We are ready for prime time. The seeds for what we're about to witness now, not just with Tesla, but with genomics, with 3D printing, with everything we do. The seeds were sown during the tech and telecom bubble. The costs back then were way too high to play out for those platforms to play out. The costs have been coming down for 20 years. We're ready for prime time. These are 3 exponential growth trends that are converging, and that is why this is so difficult for traditional analysts to value. This is all we do. We do nothing but disruptive innovation because we have never seen as much disruptive innovation evolving at the same time ever. You have to go back to telephone, electricity, internal combustion engine. That's the last time we saw exponential growth on the order that we're going to see.
I want to get in one quick question from Dan, one quick answer from you.
Just real quickly, and this is near term. Do you expect volatility around earnings? There was in the last couple of years, but like for instance, they sold cars at a 450,000 annualized rate last quarter, right? And when you look at their net income, it all came from selling tax credits. Do you expect that to be a big component of it? And does it look like that at other places around the world? We're expecting really a lot of growth to come.
Quick answer,
subsidies?
please.
Yes.
They're going to get a lot of credits from companies like Fiat Chrysler, who's paying them $500 to offset. So we think that, but that's not in our models. We never include subsidies in our models. What we're talking about right now is Tesla is ready for prime time as an EV and AV manufacturer.
All right, you got to leave it there. Cathie, thank you very much. You've done your homework on this one. Really appreciate it. Thank you.
Indeed, Cathie has done her homework. Even though Tesla stock has dropped a crazy amount from all-time highs, it is still up 146% roughly from when that interview was done. And these are 48 reasons why I only own Tesla stock in my stock portfolio. My name is Matt Postis. Like and subscribe if you haven't yet, and I will see you in the next video. Thank you so much for watching.